everything in the world is a dollar derivative. It's a dollar world, and the rest of the currencies are mere company coal mining count paper scripts. It really, I don't think I'm exaggerating. If you look at the derivatives market, which is approaching $2 quadrillion, I mean, the size of that, a lot of people can't really visualize a million. And then for people who can visualize a million relatively easily, visualizing a billion is a hell of a lot harder. A quadrillion is, then you have billion, then you have trillion, then you have quadrillion. How do you even visualize that?
You're watching CapitalCosm. My name is Danny. It is November 7th, 2025, and my guest today is Keith Weiner. He's the CEO of Monetary Metals. Keith, thank you so much for coming on the show, my friend.
Thanks for having me, Danny.
Yeah, always a pleasure having you on, Keith, especially in today's world. Let's get an update on you. We haven't heard from you in about a month or so. I want to get your recent views and takes on the gold and silver market right now. Obviously, we had a big spike up a couple of weeks ago. It's cooled down since then. What's the current prognosis you've got on the gold and silver market? Let's go ahead and kick it off with gold. I don't know if you can see my screen here, but here's the gold price right now. Hit 4,400 a couple weeks ago. Currently trading at 4,000 and some change now. So where are we at here?
All the drivers are still there. Of course, nothing moves in a straight line. That's a hell of a lot of green candles with very few. I'm on a small screen. It's hard to see, but if there's any red candles in there, what is there? Two?
There's
three?
there's a handful of red candles,
and they're really small. And they're really small also.
Yeah.
Until you get to the peak and then it breaks off. It obviously was looking like a parabolic move. Market's correct. At the end of the day, that's just noise. I mean, if you look at this 5 years from now, all the drivers are still there. Nothing is fixed in the fiat system in any way, shape, or form. And, nothing has changed really in investor, behavior, right? So something that, that we've seen, Monetary Metals has seen for a long time is Western institutional investors just didn't want anything to do with gold. Now they're all planning their, gold positions. It's kind of the inverse. When we started in 2013, we had a little hedge fund to trade the gold-silver ratio, which we wound down a few years back. And, as we talked to institutional investors about it, oh no, we're not only not taking on new exposure to gold, we're winding down, we're waiting for liquidity periods and winding down the gold exposure we have. Now is the opposite of that. They're taking positions and, all the drivers are there for it to continue. How long the correction lasts is anybody's guess. Does it go much farther down? The chart doesn't seem to suggest it. I'm certainly not a chartist by any means, technical analyst guy, but it doesn't look like it's continuing to fall. It looks like it, hit a, well, if you zoom out, obviously it looks ridiculous, but if you zoom in and you look at that drop, it looks like it's found support at around 4,000, which, shouldn't be surprising. Nice psychological, level. I can't necessarily say with any certainty whether that's it or not it, whatever. But the drivers are still there. And so in a bull market, which I always have to say, it's not gold in a bull market. Gold doesn't go anywhere. It's a dollar in a bear market. The dollar fell from, before this started, I want to say 16, 17 milligrams to the dollar, and fell to just under 7 milligrams when a couple of weeks ago. But what was I saying? Bull market.
It's not really gold in a bull market. It's the dollar. It's in a bear market.
But anyway, that bull market, continues. All the drivers are still there. Nothing's changed. Nothing's fixed. And, it's going to continue to do, what it's doing. And, I was just going to say, in a bull market, the dips tend to be relatively shallow because everyone's looking to buy them.
Hmm.
In a bear market, the dips are endless and the blips are shallow because everyone's looking to sell them. This is not your dark ages of second half of 2011 through 2018 into 2019, which was the sell the blips market. Just was. And I called that at the time, and I got a lot of hate mail, perma bear, and much worse. And this is the opposite of that. This is the buy the dips market.
Yeah, here's 2011 all the way out until 2020. It's that big. If you were to take a long-term view of it, it kind of looks like a cup, and the second half here looks like a handle. But yeah, it's like you said, you had these small blips every now and then in the gold price, and it would always get sold out not too long after. And you look at where we are today, clearly in a bull market. Now let's go ahead and shift over to silver. Silver, similar things also happen to silver. This is a weekly candlestick view of things, but it does look like we have these. We just closed out the week, or are fixing to close out the week this week, with another long wick to the bottom. Now, from a technician standpoint, this would be bullish because the price was able to get down, but then it was eaten back up. It was rejected by the buyers. So the buyers were able to overpower the sellers and bring the price back up to around $48 or so. What's your take on how we're seeing the silver price move?
So the thing that's notable in silver that just did not happen. I mean, a lot of times what's happening in silver is an amplified version of what's happening in gold. And, regular readers of mine, and I guess if they've seen enough episodes of me on your show, probably heard me talk about the gold basis, which is our measure of abundance of the metal to market, and the gold co-basis or silver co-basis is the measure of scarcity of the metal to market. These are monetary metals. They're not actually scarce because virtually all of the gold ever mined in at least 6,500 years of human history is still in somebody's hands. With silver, it's less so, but there's still a vast stocks of silver that's being held. So it's not actually scarce, but it can be scarce to market. And so we're always interested in how is the indicators of abundance and scarcity moving as the price moves. If you see the price moving up and it's becoming more abundant, that's telling you the move's not really durable. People are bidding up the futures market, which is speculators trying to front run something, but very often they end up front running only themselves. But if you see the price moving up and metal becoming less abundant to the market, then you really got something. And we saw that in silver, not in gold, but in silver. And silver actually went into backwardation, a technical term that basically means a very notable scarcity. And I haven't seen a scarcity like that in silver, I don't think ever. I'd have to go back and look at all my charts, but I've been following very closely since late 2008.
A scarcity of silver to market? Is that what you're saying?
Yes.
How do you
And so,
track that? What kind of data do you use to track the silver to market volume?
so we get a database that we license from. It used to be Thomson Reuters. It's now Refinitiv, called the Tick History database. So we're getting it after the end of close of the day. And Tick History is interesting because for true spot, right? So this is the bank's actual quotes on spot, and we get a whole bunch of different banks. And then because spot is not a cleared market, you just get all these different providers, and they're just giving quotes, and you have to make some sense of it. And we had to build the algorithm that you would build essentially if you were building a listed cleared market. But every quote, every bid and every offer on spot from all these different banks and others, that are non-bank trading houses, and every bid and offer on all the stack of futures contracts with sub-millisecond resolution. So if you analyze that data, so first of all, it's like at this point probably 6 or 7 gigabytes a day. The total database going back to 1996 is many terabytes. You can't just download it. I mean, it's far too big to stick in a database. So we had to build a big data engine to handle it. And then we built our whole little data science platform to make sense of it. you have to line up the prices in the futures market and sync them in time with the prices in the spot market, because they're two different clocks, right? I mean, futures is the COMEX cleared market in New York. Spot is a whole bunch of different banks, mostly in London, but some of them in other parts of the world. And the clocks can be off by a second or two or whatever. So you have to deal with clock skew and all kinds of different things. And as you deal with all these little sources of noise and error, then you end up with a pretty clean signal. And so anyways, the net of all this is that we saw on October 10, the peak of the silver backwardation. The spot price was $2.15 above the December contract price. And that is the bid on spot above the offer price on the December contract. So that's an actionable trade, right? If you actually had 1,000-ounce bar of silver, you could dump it on the bid price in the spot market at that price. That's an actionable price. And you could buy the December contract to get back your silver and pocket for free $2.15. And this is deemed to be a risk-free trade by the conventional system. There's no margin, right? I mean, you just sold a full 1,000 ounces of silver, you keep the cash in the account, you buy the full 1,000 ounces of silver at a $2.15 lower price. There's no risk as conventionally measured. Now, the reason why, silver being as abundant as it is, the reason why no one's taking the trade is not for lack of silver. If this happened in grain, then it could be because there's a shortage of grain, especially right before the harvest. If it happens in silver, there's not a shortage of metal, there's a shortage of trust, right? It's like I have a bar of metal, and the trade is I give away my bar and I get this piece of paper that says I'm going to get my bar of metal back. And if I have any concerns about whether that's true, maybe I won't do it. $2.15 isn't enough to make me,
right.
What do they say? Pry it out of my cold dead hands. Well, $2.15 is not enough of a pry bar, to do that. So that happened, and the backwardation had been building anyway for some time prior to October 10. It hit its peak then, and that worked out to 20% and on an annualized basis. Massive backwardation. As I said, I can't recall ever seeing silver that backwardated, which means there's a massive scarcity of the metal to the market. Now, there's the world of our central planners, and that's what central banking is. And I take a lot of guff, even from fellow Austrian economists and other free market types, really hate when I say this is central planning. It is central planning. Let's call it what it is. The world of central planning creates perverse incentives all over the place. People call it, and then perverse incentives cause, motivate perverse behaviors that cause perverse outcomes. And then people say, oh, that's unintended consequences. No, it's a logical application of the perverse incentive. So here, the perverse incentive is, okay, there's a scarcity of metal to the market. Therefore, the market should demand and pull in more metal. Well, the one logical place, I should say that one, a logical place for metal to come in is from the refiners, right? Because they're always getting new metal either from the mines or from recycling. In the case of silver, there's all kinds of industrial things that are recycled, whether it's X-ray films, whether it's used up solar panels, whether it's electrical contacts from washing machines. There's all kinds of recycling going on all the time, and people are bringing this metal to the refiners. And the refiners said, no mas, we're not taking it. And at the same time, people reported that refiners didn't have, bars available for sale, which in this case was true. Now, there's so many times in the past when people report scarcity or shortage, they don't use the word scarcity, a shortage of silver. What they mean is a shortage of retail silver products, a shortage of silver eagles, for example. Because when retail goes bananas, they want to buy eagles. That's the thing they know. That's the thing they understand. And the manufacturing capacity for eagles is inelastic. You can only stamp them out so fast. If the market demand gets greater than that, you'll pull all the inventory out of the market, which isn't that much. And then there's wait lists. So they say, oh, there's there's a shortage. Why is the silver price not going up? Well, there's not a shortage of silver in the silver market. There's a shortage of eagles in the retail eagle market, which is not the same thing. In this case, you had a real shortage of, silver in the global silver market, which is 1,000-ounce bars. And the refiners not delivering silver because they're refusing to accept, recycled silver, scrap silver, silver doré, whatever. Why were they refusing it? Because when they buy silver, they have to hedge it. No professional trade in the trade, whether it's refiners and bullion dealers, anybody wants just to buy something and take the unhedged price risk. They got to hedge it off. And at this moment in time, October 10, the cost of that hedge was 20% annualized, or $2.15, plus other fees and spreads and whatever. Well, that's far greater than the refining margin. So who would buy something where the cost of doing it is greater than the revenue to be earned by doing it? So the refiner said no. And so ironically and perversely, they actually add fuel to the scarcity fire, because they were refusing the silver because the incentive was so perverse. And that's, it's one of the things that's wrong with how our world is wired together. That's not, one of my big rants is that there are many, many defects caused by our monetary system, but those defects are not hyperinflation. So people don't recognize it. They just think, okay, if the money is defective, it's debasement. Debasement is reflected by dilution of purchasing power. It's reflected by skyrocketing consumer prices. And if consumer prices aren't skyrocketing, they're kind of like, what's the term when you go into your own house, you're nose blind? You can't smell your old sweaty gym shorts and your dog's saliva breath. Like, you don't smell all those things. That's just normal. Anyone else coming into your house, like, they may not say that, but that's what they're thinking. These perverse incentives are wired into our system in a way that people don't really see it. So they just say, well, the consumer price index isn't going up that much, as what one side would say. The other side would say, oh, it's a lie. It's going up much, much faster than that. Okay, well, how fast do you think it's going up? Well, it's 8%, not 2%. Okay, fine, 8%. It's still not hyperinflation. And yet, they're inflicting deadly damage. Look at how distorted the market for silver bars is because of this, hedging problem. Which, if we had a free market, i.e. gold standard, you wouldn't have all this. And anyway, so I'm rant mode off. But anyway, so you had a shortage, and it was a self-reinforcing positive feedback loop for a while, where the worse the shortage got, or worse the scarcity got, the less inclined that the primary deliverers of more metal to the market were to actually deliver metal.
All right, quick break here, because if you're buying gold or silver the normal way, you're probably overpaying by a lot. And that's because most retail dealers quietly tack on these huge markups, sometimes 10%, sometimes 20%, sometimes even 30%. And you don't even notice it. It's like paying $115 for a $100 bill. Doesn't make sense, right? So that's why I've been using the Bullion Standard Pro. It's a membership that basically lets you buy precious metals at real wholesale prices. The same prices that dealers get. So no inflated premiums, no middleman games. Their platform updates every 5 seconds, straight from mints and distributors. So what you see is literally the real market. And here's the crazy part. If you buy something like this gold American Eagle, here's the amount of money you're going to be saving at the time of this recording, at least. So it basically pays for itself multiple folds on many occasions, depending on what you buy. And if you want to try it out, they're hooking up my viewers with an exclusive 10% off their first month. Just use promo code COSM10 at checkout. That's COSM 10 at checkout. So if you're stacking, investing, or just tired of getting hit with hidden markups, check them out now. Bullion Standard Pro. Click on the link down below in the description box and use promo code COSM10. Now let's get back to the video.
Are we in any danger of that shortage reigniting anytime soon?
It's hard to say, but I think, whenever you study one of these things in retrospect, and I studied the one that occurred from 2010 to 2011, culminating in a silver price that nearly but didn't quite hit $50. in April of 2011. And the circumstances were kind of unique. I think that's going to prove to be the case here. Will it, it can recur because the system is kind of going off the rails, but I don't think it's particularly likely that that recurs, again, immediately. Price is off for now, back to the new normal, at the moment. But that doesn't mean silver is not, the price isn't going to rise anymore, but a driver of the price, this backwardation, is ended, for now.
For now, has there been any other time in history that you can see any parallels between this gold and silver bull market and then? Or is this a fairly novel market that we're in today?
There's certain, what's they say, in history doesn't repeat, but it rhymes. There's no one thing, people point to the 1970s. No, that was a time of rising interest rates. You can see that, interest rates want to collapse, and, politically, they're trying to prop it up, and eventually, interest rates are going to resume the falling trend. It's not that. It's not 1929 exactly either. Whether the stock market will crash or not remains to be seen. I'm actually increasingly skeptical of that, because I think, if you talk to the Fed people today, they would say that the Fed of 2007, 2008 was completely negligent, gross negligence, asleep at the switch. And today's Fed is resolving to be hyper proactive. If this is an analogy of the Dutch boy at the dike, and there's a little bit of a leak, this Dutch boy has 100,000 friends, and it could be 100,000 leaks, and there'll be 100,000 fingers plugging the leaks. And so if they don't allow a credit event to unfold, then you're not going to really see a stock market crash. And the stock market isn't the primary driver of anything. It's a consequence of something happening in credit. And if you don't allow the credit event to happen, then the stock market is responding to, yield curve inversion, ultra low interest rates, and, it's going to keep doing what it does. But I forget what your question was, but
any other time is this time reminiscent of any other time in history?
So, the thing that we have now is that the entire world has gone all in on not only the concept of irredeemable currency, but everything in the world is a dollar derivative. It's a dollar world, and the rest of the currencies are mere company coal mining town paper scripts. It really, I don't think I'm exaggerating. If you look at the derivatives market, which is approaching $2 quadrillion, I mean, the size of that, a lot of people can't really visualize a million. And then for people who can visualize a million relatively easily, visualizing a billion is a hell of a lot harder. A quadrillion is, then you have billion, then you have trillion, then you have quadrillion. How do you even visualize that?
Right.
So the derivatives market is staggeringly, stupefyingly, gobsmackingly big. And the majority of those contracts are either interest rate derivatives or, which is fundamentally unhedgeable. They just keep, forcing the risk off to the next party and the next party. And with each round, it becomes more and more complex. And eventually you get to the point where everyone thinks it's hedged. It isn't. And then, the other is the foreign exchange, derivatives. The dollar is on at least one side of over 99% of all the derivatives out there. It's literally a dollar market, and all the other currencies are, tacked on. And that's it. And I think that the gold bugs love to talk about de-dollarization because it's one of the narratives that argues for higher gold prices. And I always say, look, if something's false, it deserves to be debunked. And if that means that gold isn't going to go up, quote unquote up, then so be it. But at least be honest, with how things really work. And not only is the world not de-dollarizing, it's actually dollarizing even more. And now, if you look at these stable coins, of which Tether is obviously the biggest and first example, but there's many others coming. And different regulators around the world are creating greater clarity about stablecoins. That's going to probably pull. I mean, if you are a citizen of anywhere from even UAE, but let's say Turkey, India, some African country, some Southeast Asian country, South American country, wherever, what would you rather have? A dollar in the form of a crypto, stable coin, or would you rather have the local toilet paper currency? And not that, I mean, the UAE currency is not toilet paper. It's been pegged to the dollar and it's been stable, table flat for 30 years. But the argument's pretty compelling. You'd rather have a dollar.
Mm-hmm.
And so I think I've seen claims anyway, or predictions that will suck $1 trillion, not out of the dollar, not out of the treasury bond. This isn't shunting anything out of the U.S. banking system. This will suck $1 trillion out of emerging market banks and emerging market currencies. So the world is dollarizing even more than ever, and at the end of the day, the dollar will fail last. That is all the other currencies, failing before the dollar, not after.
So we have the DXY currently almost at 100. It's currently at 99.6. It did break 100 yesterday, and simultaneously, in tandem with that, you have crypto tanking right now. Bitcoin broke 100,000, below 100,000 momentarily last night or yesterday. Currently about $103,000 at the time of this recording. Nasdaq selling off this week. Does the fact that the DXY is getting a bid and the risk on plays are getting sold at the moment, does that portend anything meaningful at this time, or do we still need more data to reconcile the two?
Yeah, I mean, I think things are definitely wobbly in the monetary system, and that's the problem, right? Is the interest rate. You want to talk about perverse incentives. It's ultimate. It's the mother of all perverse incentives. That there's this ratchet and positive feedback loop that wants to drive the interest rate lower and lower and lower. I use the analogy of I grew up in upstate New York, where you had two things, which is you had hills and you had plenty of cold weather in the winter. And so every boy has to get to that point around 8 years old, at least in my little group, where you take a snowball and you pack it up and then you start to roll it down the hill. And the snow, usually this happened in the spring when daytime temperatures are warm enough to make the snow melt a little bit, so it got wet and sloppy, so it packed real good. And then you start to roll it down the hill and it picks up all the snow that it rolls, or not all, but most of the snow that it rolls over. And and for a while you have to kind of push it, and then it gets to a point where it's rolling on its own. And then there's a moment, call it the oh shit moment, when now it has enough mass that at 8 years old you ain't stopping it, even if you wanted to. You can run along with it for a while. It's not going that fast, but there's enough mass that the only two things that are governing its fate are gravity and whatever's at the bottom of the hill. The house with the plate glass window, the car, person, whatever. Right? It's going to stop it at the bottom. And I think the interest rate got to that point where the central banks that were pushing it and shoving it and trying to get it to roll, it's rolling away. So every once in a while they think, okay, we'll raise the interest rate, either because their astrology formulas say, okay, well, in this case, if unemployment is this, CPI is that, and so on, and M2 money supply is increased by this rate, then you have to hike the interest rate. So they have this formulas playbook. Or they just want to prove they still can, they still have the power, right? So they hike the interest rate. But if you hike the interest rate, you destroy the debtors at the margin. And those are the people whose profit margins are less than whatever the higher interest rate is that you hike. And so that's what precipitates the crisis, is you get a wave of defaults, like dominoes falling, and one default then damages the next balance sheet. And if that is not rectified, that that party can default, and then that damages the next party's bank, because one party's liability is the next party's asset. There is no actual just asset in the banking system. There's no gold. It's all credit. It's turtles all the way down. And so anyway, that's the consequence of hiking rates if things get wobbly until they want to go, slam them back to wherever they need to be, 0 or beyond. So yeah, I think we're long overdue for that. First of all, this bull market is very long in the tooth, going back to 2009. And how long can it withstand, much higher interest rates? Well, it's withstood them longer than I would have expected, but again, only because I think the Fed is and the regulators have given the wink and the nod to all sorts of parties to load up on much lower quality, bonds than they should, without taking the haircut and reserving the capital that they should.
And aren't they losing control of the long end of the curve? Because if you look at what they're doing, they're cutting the Fed funds rate, but the 10-year and the 30-year are still holding high. And the same thing happened last year. There wasn't much of a response on the 10 to 30-year yield relative to the Fed funds rate coming down last year around the same time too. So what does that imply?
Well, remember there was a yield curve inversion for the longest time, where the 10 and 30 were actually below the Fed funds rate. And so now you start lowering the Fed funds rate. It doesn't necessarily mean that the 10 has to respond immediately. But the conventional gold bug view is that it's only due to this hyper-aggressive suppression that the 10-year bond is trading at a mere 4% interest rate. It wants to be 25% interest, you see, because of all the inflation. And the Fed is, by mighty effort, keeping it down to 4%. And my view is that rates actually want to fall. And the longer the duration, the lower the effective interest rate. You take a look at stocks. Stocks are essentially perpetuities. And the implied interest rate of stocks is lower than where the 10-year bond is. So I don't think they're repressing it. I don't think there's yield curve control as such. I think you get all sorts of gyrations and wiggles and wriggles in the yield curve. Because when the Fed pushes the Fed funds rate, let's say way above where the market would clear, that's like throwing a big rock into a pond, and you get these ripples and these waves, and second order and third order effects and so on. But I think at the end of the day, the whole interest rate structure is moving down, and we'll see the lows of summer of 2021. We will return to that at some point. The 10-year traded at 0.65% in July or August of 2021. We'll get there, not instantly. And they lower the Fed funds rate, maybe the 10-year, but the 10-year's down quite a bit from where it had been. It wasn't too long ago people were calling for 5 and 6% 10-year, and now here we are, and we just peaked below 4% a couple days ago. Now it's just above 4% at the moment.
Yeah, here it is. So yeah, we were at the high of 5% back in 2023. We did hit that level. Well, no, we didn't. We got close to hitting that level earlier in the year this year, but it
looks like lower highs and we'll see, but lower lows. It looks like it was wanting to roll over. And again, I'm no technician. I'm sure any technician can say, "Oh, Keith, you're wrong," because the ran a stochastic indicator or whatever. But right. I think it wants to go down for macroeconomic reasons. But that chart to me isn't looking. I'm not seeing the parabola there the way I'm seeing in the gold price chart. That's for sure.
Kind of looks like an arc, right?
Yeah,
like an arc, like you hit your inflection point. Now it's coming down.
Yep.
Interesting. Well, all right, Keith. Anything else you want to talk about before we sign things off here?
Nothing I can think of at the moment. It's a perverse world out there.
Exactly. Well, hey, where can people find you if they want to see more of your stuff?
We pay interest on gold in gold, monetary-metals with an S.com. And on Twitter, I'm at Real Keith Weiner. That is KEI and WEI.
Awesome. Well, the links to your socials and website down below. So be sure to check them out, guys. And Keith, thank you so much for coming on, my friend. Always a pleasure. Guys, if you enjoyed this podcast, drop us a like and comment. Go, Keith, go in the comment section. If you agreed or
Keith, go.
disagreed, yeah. If you agreed or disagreed, let me know either way. I do, in fact, read all the comments. So drop me your thoughts, good or bad. I'll give them a read, and I might reply to a small handful of them as well. So, and also don't forget to subscribe to the channel so you don't miss another one of these episodes. And by liking, subscribing, commenting, doing all the YouTube stuff, it does help in boosting this episode, this channel, and this overall message in the algorithm. So if you'd like to support us in a nice and easy way that's free, everyone's favorite 4-letter F word, then a little bit goes a long way. And it's doesn't seem like much, but it does go a long way. And by checking out our good friends over at the Boolean Standard Pro, check out the link down below in the description box, as well as the pinned comment. It'll enable you to buy gold at wholesale prices at cost. So a really interesting proposition for $35 a month. You can actually get a 10% off discount by using my promo code COSM10 at checkout, COSM10 at checkout. Link and promo code down below, guys. So that's all I got for you today. I'll catch you guys later. See ya.